All right. Well, our next guest believes trade tensions could spark the next ugly sell-off. Julian Emanuel, the chief equity and derivative strategist at BTIG, is on pullback watch. Julian, welcome as always.
Great to be here.
So you think something's going to happen with this talks and we're going to see a pullback?
Well, so we go to this December 15th tariff increment. If there is a thought, and we're thinking that this game of poker might be such that the market will believe incrementally more that those tariffs are going to go on December 15th, we're overbought enough to cause a pullback there, okay? From our point of view, as a long-term investor, you don't really want to, it's noise, you don't really want to play it. If you have profits that you feel you need to lock in before year end, index option protection is very cheap. But bigger picture, we think that if you think about next year, economic consensus growth is 1.7%. That's not going to play well to the base. The president needs to create upside risk to that number. There aren't that many ways of doing it at this point, despite the fact that there was a very cordial meeting today with Chairman Powell. The Fed's on hold here, in our view. And so it really comes back to getting something done with China.
I don't know if you can have a meeting that's cordial after you call the guy a bonehead, but that's another story here. Julian, when it's the time of year where strategists like yourself put together 2020 forecasts. And so when you're thinking about 2020 and year-end targets, are you thinking about the political factor? Are you thinking about how badly does Trump want to win, and so therefore will secure a trade deal just in the nick of time or sometime during 2020, and that lifts the markets higher?
That's certainly a large part of it. So in our work, we look at presidential election years, and what we find is actually quite counterintuitive. They tend to be less volatile than other years. There are lots of tails, but if you think about it, it could be the market hesitating on taking action, either bullish or bearish, but that lower volatility tends to come more in the first half of the year, which to us could mean that as people see that the Fed is done and that the economic indicators globally are starting to bottom, you could be see a move out of bonds into stocks. And for us, that tends to, we're looking for that. We've had 10 years worth of bull market without enthusiasm. And on our year-end estimate of 179 for 2020, a median multiple over the last 30 years gets you to 34.50.
Where does the 10-year yield, where's the non-sweet spot for the 10-year yield? You can make an argument that we've been in it now for 6 months. Is it north of 2.25%? Is it somewhere below 145? I mean, where do you think things get sort of pear-shaped in terms of bond yields?
Well, at this point, the market, the psychology's changed. The yield curve is steep, and you've come off of zero. If you start heading back down below 150 in the 10-year yield, the stock market's going to run into trouble. Conversely, we think there's a lot of upside to how much the 10-year yield can go before we run into trouble. Are we going to go to 3% like last year and the year before? Not likely. 2.5 is sort of where there's probably going to be a little bit more discomfort.
By the way, just quickly, how big of a pullback if we get those December 15th tariffs?
You could test the 200-day moving average at 2,900. Our base case is you pull back to where our year-end price target is 3,000.
Okay. Julian, great to see you. Thank you. Julian Emanuel of BTIG. Tim?
The most interesting thing, I think, for folks expecting the market to, if we get Julian's scenario where Deck 15 doesn't bring in new tariffs and you're generally bullish and you're saying next year is kind of your sideways, lower vol first half, I think, Chris talks about global markets, and I would just add what's going on in the resources trade. We've been seeing kind of a bottoming in crude. I think the most interesting trade is really not just energy, but steel companies, real industrial companies, and then that rest of the world trade that I think has been such a big underperformer, except for the fact that Germany's now outperformed the S&P in local currency terms. So if you think that the dollar is going to give some ground, this would be a very powerful trade in that part of the world.
I think it was notable. Dollar was down today, right? And I get the idea that the market's stretched here. I get the idea that the market's overbought. But let's not get too cute. These have been ranges for 2 years, and stocks just broke out around the world. So I think the mistake here is overplaying our hand. If you get any hint of weakness, you have to buy it.
I didn't hear Julian mention recession. I heard him say earnings growth in 2020, and I heard him say 3450 of the S&P. Sounds pretty bullish to me.